who I've had the pleasure of knowing for these many, many years, Joe, sharing stories about the insurance business in the olden days, so to speak, up to the very present. And the one thing about our business is things are in constant change. But if you can grab on to some tried and true ideas that Joe's going to be able to share with you today and integrate them into what's happening today, I guarantee you, you're going to learn something and your clients are going to be a little bit better off for themselves. So with that, I'd like to introduce Steve Burns from AIG, and then we'll get the meeting started. So Greg, go ahead and flip the screen.
Great. Thanks, Larry. I appreciate it. And a quick commercial for InsMax before I introduce Joe. I know you guys have choices out there, but you're certainly in the right place. InsMax has an unparalleled level of case design, underwriting expertise, and advanced marketing concept knowledge. I've known Larry for quite some time and know you're in great hands with him. So kudos to you all for being here in the first place. So it's my pleasure today to introduce Joe Ross. Joe and I have started almost at the same exact time at AIG, and so we've been able to work together for 8 years now, and we've done a lot of good things together, and I couldn't be more excited to have Joe present to you guys today, and specifically on this topic. This is very prescient right now with all the discussion that's going on with tax changes and how do we fit into the life insurance industry and how do we help plan for our clients' needs. And Joe's going to go through some really interesting topics today and offer up some good solutions and some food for thought. So Joe's been in the insurance business since becoming licensed in 1978 at the age of 16, and went on to obtain his degree in finance and insurance from the University of Iowa, and was even awarded the coveted Emmett J. Vaughn Insurance Scholarship. I love this fact about Joe because I don't think all of us got into insurance necessarily on purpose, but Joe had a plan from the beginning and has really followed through and become an expert in what we do. Growing up as one of 10 kids in the town in Iowa where they filmed The Field of Dreams, Joe's career began as a member of his father's top producing MGA with E.F. Hutton Life in 1980. Their agency was consistently the top producing MGA in the country for 7 consecutive years, while Joe was among the top 70 personal producers in the country for E.F. Hutton Life. Joe then became an insurance and estate planning specialist for Merrill Lynch in 5 Chicago area offices, followed by vice president of sales and marketing for 3 life insurance companies, before spending 10 years as the brainchild behind the sales concepts that drove protective life insurance and annuity sales in both the independent agent and broker-dealer channels. In 2013, he brought those skills to AIG, where he continues to build on this legacy. Joe's articles and presentations have been featured in Broker's World, National Underwriter, Life Health Pro, and Think Advisor. And Joe's well known nationally, both for his experience and insight, and as a motivational presenter. He's highly sought after as a keynote speaker at national conferences, and I'm just really excited that you're going to get to hear from him today. I'm going to close with Joe's personal mission statement, which is to inspire people to achieve more, and Joe's certainly done that for me. And so with no further ado, it's my pleasure to introduce Joe Ross.
Thanks, Steve. Thanks, Larry, and the team at InsMax for the opportunity to be with you all today. And boy, we're going to have some fun. You're going to see stuff that you haven't been seeing before, because most people, when they're talking about the tax law changes being proposed by the new administration, they're thinking about how it's going to affect those of us who are alive. Today, we're not going to be talking about living people. We're going to be talking about dead people. We're going to be talking about the taxes that occur when people die. The official title for this presentation is Tax Prognostications, but really what I like to talk about is the legacy tax tsunami that could occur if the tax proposals that the Biden administration would like to put through actually make it through. Now, this is not intended to be a political statement. This is just based on the facts. The facts of the matter are that the Democrats and the Biden administration in particular have an interest in procuring more tax revenue from wealthy people. We've seen that all the way back to the days of the debate stage, and continuing on through the proposals that we're seeing coming out of Congress and the Senate. So part of what we're talking about today is understanding that when it comes to life insurance planning, it's not about the products we sell, it's about the stories we tell. And you're going to pick up some great stories here that you can share with your clients, which leads me to point number 2. Everything we're going to be talking about today, if I go to my first page of disclosures, and I don't usually spend a lot of time dwelling on the compliance disclosures, but here I'm going to make an exception because, as this says in the very beginning, this presentation is almost entirely founded in speculation. Why? Because the things I'm going to be talking about are tax proposals. They're not tax laws yet, they're tax proposals. And I built this presentation back in October of last year before we even knew who the next president would be. So a lot of what I've got built into this presentation is based on statements that I heard from politicians, including Joe Biden, articles that I've read, and the prognostications that I hear from people in the media, the financial professionals that give their best insights into what they think could happen. So I'm not trying to imply that any of these proposals actually will happen. Really, I want to talk about what might happen and what the situation could be if they happen. And you might say to yourself, how important is it for me as an agent or an advisor to know about tax law proposals that are not tax law yet? Well, let me tell you just a simple example from a story recently. I delivered this presentation a few weeks ago to a group of financial advisors. It was on a Tuesday morning. On Wednesday morning, I got an email from one of the participants on Tuesday morning's presentation, and he said, Joe, I'm so glad that I sat in on your presentation yesterday because yesterday afternoon, I had a meeting with a high net worth retired client of mine, and they specifically asked me what I thought the tax law changes were going to be as a result of the Biden administration and what it could do to their legacy. And because I watched your presentation, I was fully loaded with all the answers I had, and my credibility in my client's eyes went way up simply because I knew what was going on. That's the key here today. I'm just trying to help you understand what's going on and what the consequences could be so that you can better inform your clients and better strategize around the changes that might be happening. So we're going to be talking about things that you don't often hear about, but we're going to have a little fun along the way too. So if you have your camera phone, I want you to take your smartphone, turn on your camera function. We're going to have some interaction here. The purpose of this interaction is so that we can learn what each other is thinking about various topics along the way. So if you just open up your camera, point it at this QR code, your cell phone is going to give you a little pop-up. Just tap on it to accept it. And then you can let your cell phone sit there for a while because it's going to pop up a question in a few minutes that you can use to interact and participate and share ideas along the way. So just have that ready. If you didn't get a chance to snap it now, that's okay. This QR code will appear again as we go through the presentation, but don't close that section of your phone. Just leave it open throughout our conversation and you'll use it over again. Launch our presentation with a couple of quotes that I like that are really setting the stage for what we're going to talk about today. One goes back 250 years to a well-known name, Ben Franklin. In 1789, they were just finalizing the U.S. Constitution. And I'm going to give you a statement that Ben Franklin made while they were doing that. See if you can put the last sentence. I'll give you everything except the last line. See if in your mind you can remember what the last line just might be. Ben Franklin was quoted to have said, "Our new Constitution is now established and has an appearance that promises permanency. But in this world, nothing can be said to be certain." What's the next line? That's right, except death and taxes. And the reason I pulled this quote from Ben Franklin is that in today's presentation, that's what we're going to be talking about. Death and taxes, the two inescapables in life. In fact, from that, we've then lead to a second quote from a lesser known person, a philosopher from 2,500 years ago. His name was Heraclitus. I don't know who was there with their cell phone to video Heraclitus as he made this quote. I'm guessing somebody scribbled it in the sand while they were listening, but this is the quote that he is credited with having made in the year approximately 500 BC. Heraclitus said, "Nothing in life is permanent, nor can it be, because the very nature of existence is change." And it's from that statement, many of us have just summarized that by saying the only constant in life is change. And Larry was mentioning that during his opening remarks. So we're talking about three things today. We're talking about death, we're talking about taxes, and we're talking about change, all three of which are with us every day. With that as setting the stage, let's do a little bit more setting the stage. I want to talk about where we are now in regards to taxes. Now, there's a website that I refer to. Some of you might know of this website. You might be using it already. I have it referenced down at the bottom of the slide. It's called usdebtclock.org. You might want to jot that one down. You might want to tell your clients to pull up usdebtclock.org on their computer or on their cell phone to see the data that we're going to see now. When you look at the live website, it's a dynamic website that continues to adjust multiple times per second. I'm just going to show you a screenshot I took on December 21st of 2020 to show you just the point I want to make here. If you enlarge the screen and just focus in the top left corner of the screen of the usdebtclock.org website, this is what you see. And the first thing I want to focus your attention on is the U.S. national debt. Now, in December, it was $27.5 trillion. Now it's about $30 trillion. So it's gone up $2.5 trillion in just the last few months. And if you were actually on the usdebtclock.org site, you'd see this number changing multiple times per second. And if you eyeball it, you'd see that the national debt is increasing by about $100,000 every 3 seconds. That's a pretty fast increase in the national debt. The other number on this page that I like to look at is the budget deficit. What's a budget deficit? Well, we got to compare that to a budget surplus. A budget surplus is when you spend less money than you took in revenue, and then you'd have a surplus, and that would be a good thing. A budget deficit is the opposite side of that coin. A budget deficit is when you're spending more than you take in. And the U.S. federal budget deficit is how much money Congress is spending in excess of what the IRS takes in the form of tax revenue. And in the year 2020, that was an overspend of $3.2 trillion in 1 year. Now, same with you at home. If you make $150,000 a year and you spend $200,000, you just spent a $50,000 budget deficit. Where does that money come from? You most likely borrowed it. And that's what happens in the U.S. government. When we overspend by $3.2 trillion, that $3.2 trillion becomes a part of the national debt. And what you'll notice when you go out to the usdebtclock.org is that the budget deficit is the amount of the overspend, but the rate of the overspend also continues to increase, which accelerates the rate of growth of the national debt. In fact, the budget deficit is increasing by about $10,000 a second, and that's continuing to go on. I'm going to show you another number on the bottom of the screen that really caught my attention. At the very bottom of the screen, we have the U.S. federal debt to GDP ratio, and it's got the history going back 60 years. In the year 1960, the national debt was about half of the GDP. If you go forward 20 years to 1980, the U.S. national debt was about 1/3 of GDP. Go another 20 years farther forward to the year 2000, we got back up to about 50% of our GDP. But look what happened in the next 20 years. You talk about being out of step with history. For 60 years, we had a debt to GDP ratio in the neighborhood of 35 to 50%. And now all of a sudden, we're at a debt to GDP ratio of 128%. What this means is that our national debt exceeds our GDP by about 28%. And this number is so far out of step with where we've been historically, it is frightening to think about. And it's all part and parcel of this rapidly growing U.S. national debt that we faced over the years. But if that wasn't enough, one of the cool things that this website allows me to do is forecast, based on the current trends, where we are headed as far as 4 years out. So I took these numbers in 2020. I also took a look at the numbers in 2024, as far out as usdebtclock.org would allow me to go. I took a look at the numbers again. Look at what the national debt is projected to be in 4 more years. Almost $50 trillion, nearly doubling where it was in December of last year, just a few months ago. And look at the budget deficit. It's on track to increase from the current 3.2 trillion to over 5.6 trillion. And I'm going to give you some perspective around this $5.6 trillion budget deficit number. If you went back to the year 2000, the entire U.S. national debt was $5.6 trillion. Folks, we are on pace in the year 2024. If nothing changes, we are on pace to spend. Let me say that again. We are on pace to overspend what the IRS takes in by the amount of the entire national debt from the year 2000. That is startling information to me. And if this all were to happen, look what it does to the debt to GDP ratio. Again, historically, we were in that 50% range, maybe as low as 35%. But by the year 2024, we are projected to be at 170%. And if you look at the countries whose economies we don't particularly admire, they're in this range of 170% and higher. So I'm really nervous about that number. Now, why do I share all this with you? Well, it's because we're all wondering which way tax rates might go in the future, right? Your clients are asking this all the time. I'd like to get your feedback. So again, if you didn't snap that QR code before, you can open your camera and focus to the QR code now. If you just reopen your camera, you'll see that you can select and then submit your response as to which way you think tax rates will go up in the future. Do you think they'll go up? Do you think they'll go down? Or do you think they'll stay about the same? Go ahead and log in what you're thinking. Up in the right-hand corner, you can see the number of people who've already chimed in. We've got 5 people chimed in, 6. We've got complete uniformity in our responses. So far, all 6 people thinking tax rates will go up. You know, over the last 15 or 20 years, I've been asking agents and clients the same question in presentations and in personal conversations over and over and over again. And the answer I consistently get is the same answer you put on the screen here today. Now, don't close that web page on your phone, because as the next question comes up in a few minutes, it will automatically repopulate your phone and you'll be able to submit another answer. And again, if you didn't hover over the QR code yet, anytime you want, just open your camera, hover over the QR code, and click accept, and it'll launch you into the ability to give responses like these and see what your peers are thinking. So what I'm going to do today is connect some dots. What we're going to talk about is the 3 possibilities I see in the Biden administration regarding legacy taxation. If you view these 3 possibilities separately, none of them is all that big of a deal. Certainly they're impactful, but none of them is that big of a deal. None of which are big enough that I would call them a legacy tax tsunami. But if you view them in combination, that's where you get the legacy tax tsunami that we're talking about today. Again, just by way of a clarification, there is no certainty about whether any of these 3 things are going to happen. What we're going to talk about is what if they did, because obviously the Democrats are in control of the Oval Office, the House, and the Senate. They've got the opportunity to push administration tax legislation through before the midterm elections. These things could happen. So let's talk about what they are. First thing the Biden administration is talking about doing is reducing the estate tax exclusion limits. Doesn't seem like that's too hard to consider realistically, because those of us who've been around a while, we know that just 10 or 15 years ago, we had estate tax exclusion limits at a fraction of what they are today. In the 1990s, which really wasn't that long ago, the estate tax exclusion limits were $600,000 a person compared to the $11.5 million that it is today. That's a huge increase in the estate tax exclusion limits since the 1990s. And again, it was $3.5 million per person in 2009. So just 10 or 12 years ago, our estate tax exclusion limits have more than increased by more than 5-fold to give us the limits that we have today. So these are really steep increases. The Biden administration would like to scale that back. Now, this is completely consistent with the Biden administration and the Democratic concept of instilling more tax on wealthy people. Who pays the state taxes? Wealthy people do. Lower the estate tax exclusion limits, more wealthy people will pay estate tax. We're going to talk a little bit more about that in just a second. The second thing the Biden administration is talking about, the one that really bothers me the most of anything, is that they want to eliminate the step-up in basis of death. And I will tell you why this is the most concerning tax law proposal that I see in the code today. For those of you who understand what that means, and we'll talk more about it in a minute, if you are successful in eliminating step-up in basis of death, it means that when people die, they will now pay capital gains tax at death. Now think about this for just a minute. We are entering into a situation where people could pay both estate tax and capital gains tax at death. Folks, this would be the first time in the history of the U.S. tax code where people who die are exposed to double taxation on their non-qualified assets. In other words, on their non-qualified assets, they're at risk of paying both estate tax and capital gains tax. Never before has this happened in the history of the U.S. tax code. But as we're talking about eliminating step-up in basis, which creates capital gains tax at death, then the third issue becomes important, because the Biden administration would like to increase capital gains tax rates. Now, their thinking in doing this has nothing to do with death. It has everything to do with living investors, to be able to capture the tax on the growth that wealthy investors have. Again, it's aimed at wealthy people. We'll talk about what all this means in just a few minutes. So let's start by talking about the impact of the estate tax exclusion limits being reduced. So I'm going to ask you another quick question. Hover over the QR code if you haven't already. Let me see what you're thinking. It's about estate taxes. If you were to think about estate taxes, what percent of the people that died in the year 2020 would you say had a taxable estate? What percent of the people? Is it a small percent, a large percent? What do you think it is? Oh, a couple people chiming in. Let's see if we can get a couple more. And while you're doing that, just by way of commentary, if you went back to the year 2000, there were significantly more people paying estate taxes, more people who died had a taxable estate. So we've got 6 or 7 responses. Let's just assume that that's representative of the group. The vast majority of the people are thinking 2 to 5%. We've got kind of an even split between 0 and 2 and 5 to 10. A couple more answers chiming in. Thank you for participating. It's just interesting to see what our peers and colleagues think because most people don't know the answer to this question. Let me show you the answer. So most of you are thinking 2 to 5%. According to the Tax Policy Center, it's less than 0.1% of the people that died in 2020, either as an individual had over $11.5 million in their estate, or as a couple had more than $23 million in their estate and actually paid estate taxes. So you start thinking to yourself, wow, that's a really small number of people that pay estate taxes. Just how much estate tax revenue is there? So I was thinking to myself as I saw this answer, yeah, but that 0.1% of the people that paid estate taxes, those are the uber wealthy people. They're worth millions, tens of millions, hundreds of millions, maybe $1 billion. The really wealthy people, they probably pay a boatload of estate taxes, which brings us to our next question. If 0.1% of the people that died had a taxable estate, this is a further interesting question to ponder. So if that's the case, what percent of the total annual IRS tax revenue comes from estate tax? Remember, they're getting capital gains tax, they're getting income tax, they're getting corporate tax, and they're getting estate tax as their primary sources of tax. What percent of the total IRS tax revenue comes from estate tax? As you're answering, my thinking was that these people are so wealthy that maybe only 0.1% of them paid estate tax, but I'll bet a lot more estate tax revenue comes from them because they're so wealthy. And as we can see the answers come flying in, you can see what people are thinking. Looks like we got kind of an even split under 10%. Answer is, it's higher than the number of people who paid it, but the amount of tax received by the government in 2019 from estate taxes was only 0.6% of the total tax revenue. 0.6%. Folks, I got news for you. 0.6% of the U.S. federal budget is a rounding error. That is such a small number. In fact, in the year 2020, on the rate at which our government spent money, the entire 0.6% of tax revenue that came from 2019 was spent in less than a week in 2020. That's what an insignificant portion estate taxes are. And this is why the Biden administration is focused on this. In fact, in the year 2000, when the estate tax exclusion limits were much lower, we got over 2.5% of our total government tax revenue from estate taxes. And that's where the Biden administration would like to see us go. But you can start to wonder, gosh, why do we even have an estate tax? Well, 99.4% of all tax revenue is coming from somewhere else. The estate tax revenue seems inconsequential. But again, who pays estate taxes? Wealthy people do. And if the Biden administration can lower the estate tax exclusion limits, 2 things will happen. Wealthy people who were already above the limit and were already going to pay estate taxes are simply going to pay more. And those who were under the estate tax exclusion limits and didn't have to pay estate taxes based on the way things have been, they suddenly find that they do. So that's our conversation on reducing the estate tax exclusion limits. Let's talk a little bit about eliminating step-up and basis of death. This is the one that really bugs me. There's some history here that you all ought to be aware of. You see, many of us as financial advisors, when we're being taught financial advice and financial planning, we learn that there's this thing called a step-up and basis of death. But have you ever wondered why it exists? You're going to get a little history lesson here so that you know why step-up and basis of death exists. I'd like to start with a fundamental question where I ask, what's not to like about estate tax? People say, oh, estate tax isn't fair. I shouldn't have to pay tax on something just because I owned it when I died. This isn't fair at all. I hate estate tax. Well, if you have clients that are saying that, you're going to now learn how to help them reframe the way they're thinking so that they can get a better understanding of why estate tax is actually a good thing. Why is estate tax such a good thing? Well, what's the alternative to paying estate tax? The alternative is capital gains tax. So have you ever wondered why do we have a step up in basis at death? It's because the alternative to the estate taxes we pay today is capital gains tax at death. So a little history here. Before estate tax existed, when investors died, they had to pay their capital gains tax on their capital gains and their assets when they died. There's a problem with that. The problem is when you're trying to calculate capital gains tax, the only way to calculate it accurately is to know the cost basis of that asset. Now, my parents both passed away within the last 10 years, and as their executor, I cannot imagine what misery I would have had to go through to try to figure out the cost basis in my parents' assets. It would have been an absolute nightmare. Like, just take an easy example, their house. Oh my goodness, my parents repoured their concrete driveway twice. Do I have any idea what they spent to do that? That would have been an improvement to their home, and it would have added to their cost basis. They replaced their roof, they replaced their siding, they replaced all their flooring, they replaced furniture, air conditioners, water heaters, all of these things that could add to the value of their home, add basis to their home. I wouldn't have any way of knowing what that was. And what we learned was a cruel lesson in 2010. In the 1 year in recent memory where estate tax was repealed for 1 year. What happened when estate tax got repealed? The step up in basis also got repealed. And what that meant is when you died in 2010, you didn't pay estate tax, but you did pay capital gains tax. And it was a nightmare because of the people that had to figure out the decedent's cost basis. So what you learn here is that estate tax at death and capital gains tax at death are both death taxes. We should logically have one or the other. We shouldn't have both. And in fact, the beauty of estate tax is that its primary purpose was to replace capital gains tax at death. So here's what happens. Capital gains tax at death is way more difficult to calculate because you have to document the cost basis. So Congress said, let's make everybody's life easier. Let's get rid of capital gains tax at death and let's replace it with something that's much easier to calculate. We'll call it an estate tax. It's so much easier because you don't need to know the cost basis. Just value the asset and pay tax on it. It's just that easy. That's why estate tax exists. Not to penalize people, not to tax people just because they own stuff, but in fact, it's there to make life easier. It's there to replace capital gains tax. And that's where step up in basis at death comes from, because when you choose to impose an estate tax, you have to figure out how to make capital gains tax go away, but only make capital gains tax go away at death. You still want living investors that are buying and selling capital assets to pay capital gains tax, but you don't want people to pay capital gains tax at death. How do you do that? Just going to check here. So how do you make that go away at death? You do that with the step up in basis. When you step up the basis at death, what happens? Living investors still pay capital gains tax. Investors that die do not. Instead, they pay estate tax. So, based on what you just learned, if you were given a choice, which would you rather pay? Estate tax when you die or capital gains tax when you die? What do you think? Pick up your phone, take a look, select an answer, and click submit. The QR code, it's right there. Looks like we have some consensus of opinion. It looks like people are agreeing that estate tax is preferable to capital gains tax. Now, I got somebody who says they'd like to pay capital gains tax at death. I can only suggest that you are a glutton for punishment if you want to pay capital gains tax at death. But here's the bigger problem that I see here. The Biden administration wants to reduce the estate tax exclusion limits so that people will pay estate tax at death, but they also want to eliminate the step up in basis, which causes people to pay capital gains tax at death. And that's the problem that I'm struggling with. This is why out of all of the options that we've seen, this eliminating step up in basis at death really bugs me. First of all, because it's complicated, because you have to find the cost basis in the assets. And secondly, because it creates a double tax on non-qualified assets. Now, we're used to talking about double tax on qualified plan assets, right? You die with an IRA, and if you've got a big estate, you're going to pay estate tax on the IRA, and you're going to pay the beneficiaries are going to pay income tax on the IRA. Well, here we have double tax on non-qualified assets. And again, we've never had that before. Every time we've had an estate tax in the past. We've had a step up in basis of death to eliminate the capital gains tax. And then that leads to capital gains tax rates. And what if they increase? First of all, I'm going to give you another quick history lesson. Why do we even have capital gains tax rates? Why is there a lower tax rate for capital gains than there is for ordinary income? If you understand this history, the rest of today's conversation will make even more sense. The reason capital gains tax rates are lower than ordinary income tax rates is to provide an incentive. Lower capital gains tax rates encourages investors to invest in public companies, which of course then spurs on the American economy. So they created capital gains lower tax rates to encourage investors to do exactly this. But here's the problem. What kind of investors invest significantly in capital gains? Small Main Street everyday employees or uber wealthy people? And the answer is it's the uber wealthy people that make substantial investments in capital gains assets and benefit the most from the reduced capital gains tax rates. So, because wealthy people are more likely to be capital investors, capital gains tax rates could be easily perceived as a tax break for the wealthy. Is this starting to resonate? This is why the Biden administration is interested in raising capital gains tax rates, is because it's a way to excise more tax from the wealthy, consistent with the entire agenda that they have. So the Biden administration has suggested that they would like to increase the capital gains tax rates. Their proposal, I was guessing at this back in October, but their proposal was 28%. Now it seems like that's being negotiated. It might be lower than that. But there was also a second thing that came up, and I guessed at this back in October, but here it is. The Biden administration, I was guessing, would like to possibly raise capital gains tax rates to equal the ordinary income tax rates. Have they done it? It appears as though they're trying, because you can see in their proposals that if you have more than $1 million of household income, over $1 million of household income, regardless of the source, it could be employment income, it could be any source of income. If your household income is over $1 million, the Biden administration is proposing that you would eliminate the lower capital gains tax rates for those individuals, which would mean those assets, capital gains, would be taxed at ordinary income tax rates. Now, you can see where this would clearly be an elimination of a tax preference for the wealthy, but it does come with some other consequences as well. If you're going to remove the lower tax benefits of capital gains investing, you're going to mess with the incentive that wealthy investors have to invest in America. And what is that going to do in terms of spurring on the growth in the economy? Time will only tell. So that's your backdrop on these three things. The question is, could any one of these happen? Could more than one of these happen? And what if they all happened? What I would call the perfect storm. The best way for me to give you an example of what happens in the perfect storm, if all three happened, is to use a simple case assumption. So I'm going to use a simple case. I'm going to take a couple. Remember that right now for a couple, the estate tax exclusion limit is approximately $23 million. I'm going to assume that we have a couple that's worth $33 million. Why $33 million? Because I wanted a simple round number here, a $10 million difference. So they have $10 million more than the estate tax exclusion limits. Now I know these tax calculations for estate tax are complicated. I'm going to show you the back of the cocktail napkin kind of math that we typically use when we're talking to clients. So here are my assumptions. If your client's a single individual worth $11.5 million, I'm assuming, with an estate tax exclusion limit of $11.5 million, I'm going to assume that they're worth $21.5 million. So they're worth $10 million more than the exclusion. Or we can just consider this example where the estate tax exclusion is $23 million, their actual net worth is $33 million. That means they have $10 million more than the estate tax exclusion. The other assumption that we'll make here is that the estate tax rate is today's maximum marginal estate tax rate of 40%. Those of you who've been in the estate tax sandbox know that it wasn't that long ago that that rate was 55%, and it could go back there. But this is where it is today. So let's use that in our example. So here's my simple calculation. Under today's rules, they're worth $10 million more than the estate tax exclusion limit. So they have $10 million exposed to estate tax. They have a 40% estate tax rate. This math's pretty easy. They owe just $4 million of estate tax. Now, $4 million of estate tax seems like a pretty hefty number. None of us on today's on today's call wants to write that check for $4 million to the IRS. But in the reality of it, if you take a look at our example, if this was a $33 million couple and they wrote a check for $4 million in estate taxes, they still have $29 million left. I don't think anybody in their family had to move to the poor farm because they ended up with just a paltry $29 million. So even though $4 million is a big check to write, in the grand scheme of things for an estate that's worth $33 million, it's not that big of an impact. It is survivable. And this is the back of the cocktail napkin math that we use today. Now, let's assume that the perfect storm happens. Let's assume that the estate tax exclusion limits came down, step up in basis of death got eliminated, and the capital gains tax rates increased. So now we have to add a couple of more assumptions so that we can do the math, right? So first assumption we're going to make. The estate tax in the first example was based on having $10 million over the estate tax exclusion limit. In this example, I'm going to add 10 million more. So what I'm going to do here is reduce the estate tax exclusion limits by another $10 million. So now this exact same couple that had $10 million exposed now has $20 million exposed. Now that $20 million that's exposed also has the potential for capital gains tax because of the lost step up in basis of death. So what we're assuming here in my example is that that $20 million sleeve of assets that's exposed to estate taxes has a cost basis of $5 million. Therefore, it has an embedded capital gain of $15 million. So we've got 20 million exposed to estate tax. We've got 15 million exposed to capital gains tax. The last thing we need to know is our capital gains tax rate. I'm going to use 28% for simplicity's sake. It could be 22%, could be 24% if they negotiate down. It could be 39.6% if a wealthy estate loses its capital gains tax benefits altogether. So let's just use this as a proxy to see what happens if the storm happened to your client. So we have $20 million exposed to estate taxes. We use the exact same estate tax rate of 40%, and now we've doubled the estate tax from our first example to $8 million. But this $20 million sleeve of assets also has $15 million of capital gains in it. So if we take the $15 million of capital gains and we tax that at a 28% tax rate, that creates $4.2 million of capital gains tax. Notice that the capital gains tax in this simple example are greater than the entire estate tax that was going to be paid in the previous example under the current rules. And in addition to the $4.2 million in capital gains tax, they're also going to pay $8 million of estate tax, which would create total tax of $12.2 million. Mathematically, we have more than tripled the total legacy tax than what we had in the previous example of $4 million. In fact, if you take this $12 million of tax and divide it into the $20 million of exposed assets to get what your functional taxes are as a percentage of the assets being taxed, you will lose 61% of the value of that asset in this example due to the perfect storm of reduced estate tax exclusion limits, elimination of step up in basis, and a moderate or mild increase in the capital gains tax rate. These are big numbers. Now you're looking at that same couple that had an estate worth $33 million. After paying $12.2 million in tax, they're going to end up being worth closer to $20 million. Now, I'm not saying they're going to go to the poor farm because they're down to $20 million, but that is a huge amount of tax to go from 33 million down to 20 million just because of estate tax and capital gains tax. And what have we ignored so far? We have not even talked about the income tax the beneficiaries are going to pay on any IRA assets that might also be included in that mix, which would make the storm even worse. Now, I know I sound very doom and gloom here, but when you look at this, I want you to have a couple of takeaways. We know what double tax is. We used to have double tax over and over again in qualified plan assets. If the estate tax exclusion limits come down, we are going to see double tax on retirement assets reappear because people will pay estate tax and their beneficiaries will pay income tax on their IRA assets. In addition to that, they have the potential for double tax on their non-qualified assets through estate tax and capital gains tax. Folks, this is not news that we typically get excited about. Why is it important? Well, it's because it's not all doom and gloom. Because when we think about tax increases, and I've been at this since 1978 when I first got into the life insurance business, what I've noticed is tax laws continue to change. And every time we think a tax law comes into change, it's going to ruin everything, it creates opportunities. If tax rates increase, and right now the Biden administration is saying no one who earns under $400,000 is going to see a tax increase, but households earning over $400,000 could see tax increases. If they do, they're going to be looking for ways to reduce their tax, and life insurance tax advantages are going to become even more attractive than they are today. Those tax advantages are the tax-deferred growth, tax-free access during their retirement, and the tax-free death benefits to their beneficiaries. So let's look at a couple of solutions that you have the opportunity to talk to your clients about. If individual income tax rates increase, your clients are going to be interested in hearing about LIRP, life insurance retirement plans, where they can sock money away inside of a life insurance policy and get tax-deferred growth and tax-free access during their retirement. And any residual left in that account passes their beneficiaries income tax-free. If step-up in basis at death gets repealed, life insurance can solve that problem too, in a way that most agents and advisors have not thought about. Let me give you an simple example. Let's say I've got a 55-year-old male, and let's just say he's a standard risk. If he buys a $1 million guaranteed death benefit life insurance policy, and I know there's not a lot of GUL policies out there, but if he paid premiums until he was 85 years old, his total premiums, if you solve for a level premium for lifetime premiums, his total premiums over his entire lifetime through age 85 would be about $400,000. Now you might be thinking to yourself, gosh, $400,000 sounds like a lot of premium, but it's actually a pretty good deal because if you died, your beneficiaries are going to get $1 million. That's a $600,000 increase in value over what you paid, right? You follow me? Now, in the life insurance business, when we talk about the premiums you pay into a life insurance policy, we know that to be your client's cost basis. So this client has $400,000 of cost basis in this asset. When they die, their beneficiaries are going to get a $600,000 increase in value when they receive that $1 million death benefit. And that entire benefit will be income tax free. What does that look like to you? Does that look like a step up in basis of death? It sure does to me, because your basis was $400,000 and you didn't have to pay any tax on the increase in value, which means you basically got a step up in basis of death and got $1 million income tax free. My point here is this. If your clients become concerned that they may owe capital gains tax at death on assets they own today, they may find it attractive to liquidate those assets at today's low capital gains tax rates, redeploy those assets into a life insurance policy with the biggest death benefit they can find, so that when they die, they get this big death benefit income tax free, essentially creating their own step up in basis of death, the same step up in basis of death that the government might take away. And the third area where we have opportunity knocking on our door again is if the estate tax exclusion limits are reduced, more people are going to owe estate taxes, which means we can go back to putting life insurance policies inside irrevocable life insurance trusts like we used to help people offset or totally eliminate the impact of estate taxes to their legacy. So I don't just see this as problems, but the key is this. Human nature suggests that we, as human beings, have an interest in moving away from pain and towards pleasure. And that's the key to why we're talking about all this. Your clients can see a lot of pain in these tax code or tax law proposals. If this pain happens, we have the ability to alleviate your client's pain with life insurance. So the question I have, and you get to participate in this one more time, so get your cell phone handy. Will the perfect storm happen? Let me ask you this question. Which of these 5 things do you think is most likely to happen? First, I have listed the 3 different things that could happen. The 4th option is more than one of them. And the last option is all 3 of them. Which of these do you think is most likely to happen? Let's see what our peers think. More than one above. I'm kind of a believer that the estate tax exclusion limits getting reduced is highly likely because it looks like an easy one. I've heard some professional prognosticators saying that the step up in basis of death being lost has a high likelihood of being approved, which amazes me. We've all been watching the debate on the capital gains tax rate. So interesting how we see the results come in. I'm inclined to think that, like the vote is coming in, more than one of the above. But isn't it interesting to see what your peers are thinking? We got a 1/4 of the group that voted saying, I think all of the above things are going to happen. That's a pretty significant number. And it's a good takeaway for all of us to realize that your answers are probably representative of what the world thinks as well. Now, will the perfect storm happen? A lot of stars would need to align. We know that there's a lot of political dysfunction in Washington, making it hard to get things done. The changes we're talking about are fairly dramatic. I expect a lot of pushback. One can wonder whether the economy can handle all of this tax change at death, in addition to the tax changes to people while they're living, and see what happens. So I finish with just a couple of quotes. What are we supposed to do about this? What can we as advisors and agents do to help our clients? Well, first is that psychological principle that Sigmund Freud documented in 1911, saying that people make choices to avoid pain and create pleasure. The reason I pulled this quote up is because when the IRS changes tax laws to increase taxes, they're creating pain that your clients want to avoid. And in our business, we have the ability to turn that pain into pleasure by using life insurance products. That's why I pulled that quote. The second quote I'll share with you is a physics quote that many of you have heard, and that is, for every action, there's an equal and opposite reaction. And the reason I pulled this quote is because the government will take action, they will change things, and we have the opportunity to help our clients make an equal and opposite reaction to those changes to help offset or eliminate the impact and implication of those tax law changes. I know this was a ton of stuff to race through. You can